Yep. It's the finale, the Holiday Trader 2. Uh, yes, guys. Hello today, and welcome to the Holiday Trader 2. Here we'll be talking a bit about, doing a recap of everything we have done about since the inception from Financial Literacy 1 and 2, the Guru Trader 1 and 2, Forex Anatomy 1 and 2, and finally we're here, the Holiday Trader. And we're in the second part, the one before we go on the Christmas break. So we still have a lot more to learn come the beginning of the new year. But now we'll be wrapping up with this. We'll be wrapping up with carry trades. We have a lot of people who leave their trades over 1 day, 2 days, 1 week, like that. And then we'll be talking about the dollar smart theory, a very effective theoretical trading strategy. How gold affects AUD, USD, and USD turf, how bond yields also affect currency movements. We'll be talking about all of this. Forex and global equity markets, how the stock market affects the Forex market. We'll be talking about intermarket analysis cheat sheet, very importantly. And just stay tuned. Get a lot more about how the market evolves, how you can be a successful trader in this new age, in this jet age. So let's get on the next page. Right now, trading the news. We have a very, very good understanding about news events now, based on almost all the news events we have spoken about. Based on the important economic news events in different countries. It's always good to understand the underlying reasons why the market moves in a certain direction when news events are being released, And when you have a directional bias, you are expecting price to make, or rather to move a certain direction, and you have got your orders in already. When you have a non-directional bias, you don't care which way the price heads. You just want to get triggered. But we have setups for the non-directional bias, which are also called straddle trades. That's pretty more like it. And is it really that easy? That's what the question is on everyone's mind. But we will know very soon how it works. Next page, please. Now, definitely not. You will have to practice and you have to, trade different reports before you get a feel of which news reports will actually make the market move. How much of a surprise is needed for the market to move, which reports to avoid trading, like if in any other trading method, your success depends on your preparation, right? This will take time and practice. You definitely have to do your homework and study economic indicators to understand why they are very important. And remember, nothing worth having comes that easy. So you got to stick with it. And you find out that trading the news will be very rewarding once you get the hang of it. Next page, please. So, with all that being said, we are diving into a very, very important topic because we more notice that most traders usually have this dilemma. Always got caught up in such dilemmas, and you sometimes don't know how to come out of it. This is called a carry trade. Now, what is a carry trade? Do you know that there is a trading system that can make money if price stayed exactly the same for long periods of time? Now, a carry trade simply involves borrowing or selling a financial instrument with low interest rate than using it to purchase a financial instrument with a high interest rate. So more say let's say for instance, you are more or less paying low interest rate on the financial instrument you sold, and you're collecting a higher interest rate on the financial instrument you purchased. Now, the profit is the money you collect from the interest rate differential. That is the profit you collect from the interest rate differential, which makes it very top tier for us to deal with, right? Next page, please. Now, in that same ideology, we have it represented in Forex, the currency carry trade. Now, the currency carry trade is in Forex market, currencies are traded in pairs. For instance, you have Euro USD, GBP USD, USD CHF. You're actually buying the US dollar and selling the Swiss francs at the same time. Now, just like the example in the previous, you pay interest on the currency position you sell, and you collect interest on the currency position you buy. So what makes the carry trade be special in the spot Forex market is that interest payments happen every trading day based on your position. Now, technically, all positions are closed at the end of the day in the spot Forex market, but you don't see it happen. That's the truth. You don't see it happen. If you hold a position to the next day, brokers close and reopen your position, and then they debit or they credit you the overnight interest rate difference between the two currencies. This is the cost of more or less carrying, let's say, rolling over a position to the next day. Now, this is where most traders get a hang of or get stuck in this dilemma. The amount of leverage available from Forex brokers has made the carry trade very popular very popular in the spot Forex market. Now, most Forex trading is margin based, meaning you only have to put up a small amount of the position and your broker will put up the rest. And many brokers ask as little as 1% or 2% of a position. And, what's the deal, of course? Now, the truth about this is that, next page, please. There's a generic example to show how awesome this can be, of course. For this example, we will take a good look at Joe, the newbie Forex trader. Now, it's Joe's birthday, and his grandparents, being the sweet and generous people they are, gave him $10,000. So sweet, of course, because instead of going out and blowing his birthday present on video games, bubblegum, popsters, and the rest of it like that, you know, Joe goes to the local bank, opens a saving account, and the bank manager tells him, Joe, your savings account will pay 1% a year on your account balance. And now tell me, isn't that fantastic? Joe gives a pause and thinks to himself, at 1%, my $10,000 will earn me 100 in a year. Now, that doesn't seem right to Joe because being the smart guy he is, he's been studying, um, studying all about Forex and knows of a better way to invest his money. So Joe kindly responds to the bank manager and says, I'll invest my money somewhere else, which is a brainer. Next page, please. Now, Joe has been trading on the demo account several systems for over a year, so he has a pretty good understanding of how Forex trading works. And, he opens a real account, he deposits $10,000 birthday gift and puts his plan into action. Now, Joe finds a currency pair whose interest rate differential is 5% a year, and he purchases $100,000 worth of that pair. Now, since his broker only requires 1% deposit on that position, they hold $1,000 in margin, which is a 1:100 leverage. So Joe now controls $100,000 worth of a currency pair that is receiving 5% a year in interest. So what will happen to Joe's account if he does nothing for a year? Here are the three possibilities. One, the currency position will lose value. The currency pair which Joe drops like a rock in value, and loss brings the account down to the amount set aside for margin. Now the position is closed, and all that's left in the account is the margin, $100,000. Two, currency position will gain value. Joe's pair will shoot up like a rocket, So not only does Joe collect at least $5,000 in interest on his positions, but he also takes home as many gains as possible. That would be a nice present to himself, And because of the 1:100 leverage, Joe has the potential to earn around 50% a year from his initial $10,000. Now, lastly, the pair ends up at the same exchange rate at the end of the year. In this case, Joe did not only gain or lose any value of his position, but he more or less collected a percentage, 5% interest on the $100,000 position, which actually means that on an interest alone, Joe made $5,000 on all his $10,000 account. That's a 50% gain, which is of course very, very amazing. Next page, please. Now, there is an illustration to this. A currency pair that offers 4.4% differential rate based on interest rates on September. Now, you enter a long position on AUD JPY, you receive 4.50% from a long AUD position. It pays 0.10% from short JPY positions. And your profit is 4.40% in interest rate spread if spot rate remains constant, of course. Now, if you buy AUD JPY and you held it for a year, you earn a positive carry of plus 4.40%. Of course, if you sell AUD JPY, it works the opposite way. It works the opposite way, right? Next page, please. Now, if you sold AUD JPY and held it for a year, you would earn a negative carry of minus 4.40%, right? Now, you receive 0.10% from long JPY position. You pay 4.50% from short AUD positions. Your loss of minus 4.40% in interest rate spread if spot rate remains constant, right? Next page, please. This is a generic example of how carry trade works. So you have, you see the illustration diagrammatic, half full, awesome, half empty. Now you know when you carry, when your carry trade works and when they won't. Now it's time to move on to the most important part of this lesson, which is called the carry trade risk. Very importantly, next page, please. When do carry trades work? Now, carry trades work best when investors feel risky and optimistic enough to buy high yielding currencies and sell lower yielding currencies. It's kind of like an optimist who sees the glass half full. While the current situation might not be ideal, he's hopeful that things will get better. And the same goes for carry trade. Economic conditions may not be too good, but the outlook of the buying currency does not seem to need to be positive. Of course, if the outlook of a country's economy looks as good as Angelina or Brad Pitt, then chances are there that the country's central bank will have to raise interest rates in order to control inflation. Now, why do carry trades not work? On the other hand, if a country's economic prospects are looking too good, then nobody will be prepared to take part of it. So to put it simply, carry trades work best when investors have low risk aversion. On the other hand, if a country's economic prospects aren't looking good, then nobody will be prepared to take on that currency if they think that the central bank will have to lower interest rates to help their economy. Next page, please. Carry trades do not work well when risk aversion is high. That is, you're selling higher yielding currencies and buying back lower yielding currencies. When risk aversion is a bit high, investors are less likely to take risky ventures. Let's put this into perspective. Let's say economic conditions are a bit tough and the country is currently undergoing a recession. What do you think your next door neighbor would do with this money? Your neighbor would probably choose a low paying yet safe investment than put it somewhere else. It doesn't matter if the return is low as long as the return of investment is a shorting. Now, this makes sense because this allows your neighbor to have a fallback plan in the event that things go bad. You lose your job. In Forex jargon, your neighbor is said to have a high value of risk aversion. And the psychology of big investors isn't that much different from your next door neighbor. When economic conditions are uncertain, investors tend to put their investments in safe haven currencies that offer low interest rate like the US dollar and the Japanese yen. Now, if you want a specific example, you check out Forex Gump's you check out some of our details on Forex Anatomy on how risk aversion led to unwinding of a carry trade. And this is more like a polar opposite of carry trade because this inflow of capital um, causes currencies with low interest to appreciate against those with high interest, of course. Next page, please. Now, the carry trade criteria and risk, carry trade criteria. It's pretty simple to find a suitable pair to do a carry trade. Look for two things. One, find a high interest differential. And number two, you find a pair that has been stable or in an uptrend in favor of the higher yielding currency. Now, this gives you the ability to stay in the trade as long as possible and profit off the interest rate differential. Now, let's take a real life example of the carry trade in action. Take a good look at this. Let's take a bit zoom into the link, now you're seeing probably you took a trade at the price point of 76.41, and from let's say early 2009 to 2010, this pair had gained approximately an amazing 3,250 pips. Now, the uptrend and interest rate differential of the pair has made it a very nice investment during this period, which gives it a very, gives it an upper hand when it comes to all of these things. Next page, please. This is a weekly chart of AUD/JPY. Now, up until recently, the Bank of Japan has maintained a zero interest rate policy. Currently, the interest rate stands at 0.10%, with Reserve Bank of Australia touting one of the higher interest rates among the major currencies, 4.50% in the chart example. Many traders have flocked to this pair, one of the factors creating a nice little uptrend in the pair. Now, from the start of 2009 to early 2010, this pair moved from a price of 55.50 to 88.00. That's more like, let's say, 3,250 pips. Now, if you put that with interest rate payments, with the interest rate differential of the two currencies, this pair has been a nice long-term play for many investors and traders able to weather the volatile up and down movements of the currency market. Of course, economic and political factors are changing the world daily, and interest rates and interest rate differentials between currencies may change as well, because bringing popular carry trades such as the yen carry trade out of favor with the investors will make it only come out very good. Next page, please. The carry trade risk. Because you're a very smart trader, you already know what the first question you should be asked. You should ask before entering a trade is, right? What is my risk? Before entering a trade, you must always assess your maximum risk, whether or not it is acceptable according to your risk management rules. In the example at the start of the lesson with Joe, the newbie Forex trader, his maximum risk would have been $9,000. His position would be automatically closed out once his losses hit $9,000. Now, in summary, why you're paying carry trade in summary is this: why you're paying the low interest rate on the financial instrument you borrowed or you sold, you are collecting higher interest on the financial instrument you purchased. Now, your profit is the money you collect from the interest rate differential. This is, of course, another way to make money in the Forex market without having to buy low and sell high, which can be, pretty tough to go day after the day. Next page, please. Now, carry trades, they work best when investors feel like taking on risk. current economic conditions need not to be good, but the outlook does need to be very positive. If a country's economic prospects aren't looking too good, then nobody will be prepared to take on the risk. To put it simply, carry trades work best when investors have low risk aversion. Carry trades do not work well when risk aversion is high. When risk aversion is high, investors are less likely to buy higher yielding currencies or likely to reduce their positions in higher yielding currencies. Now, when economic conditions are uncertain, investors tend to put their investments in safe haven currencies, now which tend to offer low interest rates like the US dollar and the Japanese yen. It's more very pretty simple to find a suitable pair to do a carry trade. You look for two things. One, you find a high interest differential. Very important. You find a high interest differential. Then number two, you find a pair that has been stable or in an uptrend in favor of the higher yielding currency. This gives us the ability to stay in the trade as long as possible and profit off the interest rate differential. Always remember that economic and political factors are changing the world daily, because interest rates and interest rate differentials between currencies may change as well, bringing popular carry trades such as the yen carry trade, out of favor for investors. So when doing a carry trade, you should still limit your losses with a regular directional trade. Now, when properly applied, the carry trade can add significant income to your account, along with directional trading strategies. Yeah. Next page, please. So, as I said, next page, please. What is the US dollar index? Yep. Now, the US dollar index, the US dollar, first of all, is the powerhouse when it comes to trading on the financial market. Now, the US dollar index, if you have traded stocks, you are probably familiar with all the indices available, such as the Dow Jones Industrial Average, DJA, NASDAQ Composite Index, Russell 2000, S&P 500, Wilshire 5000, and Nimbus 2001. Well, if US stocks have an index, US dollar can be out of it, because for currency traders, we have the US dollar index. The US dollar index consists of a geometric weighted average of a basket of foreign currencies against the dollar. Now, before you feel a bit down or maybe confused about all these things, it's very similar to how the stock indices work, in that it provides a general indication of the value of a basket of securities. Of course, the security we're talking about here are the major world currencies, of course. Next page, please. The US dollar index currency basket consists of 6 foreign currencies. They are the euro, the yen, the pound, the Canadian dollars, the Swedish krona, Switzerland franc. If the index is made up of 6 currencies, here many currencies included. If you answer, there are 24 countries rather, total, because there are 19 members of the European Union that have adopted the euro as their sole currency. But the other 5 countries, which is Canada, Great Britain, Sweden, Japan, Switzerland, and their accompanying currencies. It's obvious that 24 countries make up a small portion of the world, but many other currencies follow the US dollar index very closely, just like I do. Now, this makes the USDX a pretty good tool for measuring the US dollar's global strength. Right? Next page, please. The US dollar index components. Now that we know what the basket of currencies is composed of, let's get back to that geometric weighted average part, because not every country is the same size. It's only fair that each is given appropriate weights when calculating the US dollar index. Now, check out the current weights. With its 19 countries, euros make up a big chunk of the US dollar index. The next highest is the Japanese yen, which would make sense since Japan has one of the biggest economies in the world. The other four may up less than 30% of the USDX, you know. Next page, please. How to read the US dollar index. Just like any currency pair, the US dollar index even has its own chart. You know, first you notice that the index is calculated 24 hours a day, 5 days a week. Also, the US dollar index measures the dollar's general value relative to a base of 100,000 units. Now, for example, the current reading says 86.212 from the chart. This means that the dollar has fallen an amazingly 13.79% since the start of the index. So 86.212 minus the 100,000. If the reading was about 120 per 650, it means that the dollar's value has risen about 20.65% since the start of the index. So which makes it a difference of 120.650 from 100,000 index. Now, the start of the US dollar index in March 1973, this was the world's biggest nations met in Washington, D.C. And they all agreed to allow the currencies to, float freely against each. And the start of the index is also known as the base period. Okay, next page, please. Similarly, the US dollar index has a formula, and the formula for calculating the USDX is it's a bit cheeky. Let's take for instance for some numbers on Euro USD 50.14 multiplied by the currency price point of 0.576 multiplied by the USD JPY to the power of 0.136 and the GBP USD2 followed by that of minus 0.1919 and the USD CAD of 0.091, USD SEC 0.042 as the USD CHF 0.036. Now you get a huge cool understanding about this. Now, you want to trade on the weighted dollar index. There is also another kind of dollar index used by the Federal Reserve, which against foreign currencies based on how competitive US goods are compared to goods from other countries. Now, it was formed in 1998 in order to keep up to date with the US trade. Next page, please. Now, the main difference between the USDX and the trade-weighted US dollar index is the basket of currency used and their relative weights. Now, the trade-weighted index includes countries from all over the world, including some developing countries. Given how global trade is developing, this index is probably a better reflection of the dollar's value across the globe. Now, the weights are based on annual trade data. Now, here are some important zones and the countries and their weights. You have the Eurozone at 16.22. We have China at 20.81. We have Canada at 12.618. We have Mexico at 11.67. We have Japan at 7.552. We have United Kingdom at 3.393. We have Korea at 3.8. We have Taiwan at 2.381. Singapore at 1.889. We have Brazil at 2.204. Brazil. We have Malaysia at 1.467. We have Hong Kong at 1.269. We have India at 1.958. We have Switzerland, Thailand, both arguably, we have Switzerland 1.634. We have Thailand and Australia, arguably at 1.40 and 1.415. We have Russia at 1.202. We have Israel at 1.034. We have Sweden at 0.734. We have Indonesia at 1.063. We have Saudi Arabia at 1.071. We have Chile at 0.876. We have the Philippines at 0.553, Colombia 0.664, Argentina 0.63. We have Venezuela at 0.485, a total of 100. Next page, please. How to use the USDX, the US dollar index in Forex trading. Now, I bet you're wondering, how do we use this in trading Arsenal? Well, you just get a hang of it. And we all know that most of the widely traded currency pairs include the US dollar. Yes, the US dollar is the powerhouse. We keep saying it. And if you don't know, same that includes the US dollar are Euro, USD, GBP, USD, USD, JPY, USD CAD, and USD CHF. Now, what does this mean? If you trade any of these pairs, the USDX can be the next best thing to slide, hamburger or anything like that. But if you don't know, the USDX will still give you an idea of the relative strength of the US dollar around the world. Now, in fact, when the market outlook for the US dollar is unclear, more often times than not, the USDX provides a much more better picture of these things. Next page, please. To the next page, please. Here is a chart of the USDX daily chart. I think a bit older chart, because the USDX is comprised of more than 50% by the Eurozone. Euro USD is quite inversely related. So you're checking this, you're seeing how the USD index is always represented. Next page, please. Now, it's like a mirror image. If one goes up, the other most likely goes down. And it seems like the trend lines almost inversely match up perfectly. This could be a big help to those big on trading USD or USD. You take, for instance, the upside and the downside, and the build up to this. This is the Euro USD daily chart. You could notice that they actually move exactly almost the same way as the USD index. Next page, please. Now, if the USDX makes significant movements, you can almost surely expect currency traders to react to the movement accordingly, because both the USDX and Forex traders react to each other. Breakouts in spot USD pairs will almost certainly move the USDX in similar breakout fashion, because to sum it all up, Forex traders use the USDX as a key indicator for the direction of the USD. So always keeping in mind the position of the USD in the pair you are trading. Now, for example, if the USDX is strengthening and rising and you are trading Euro USD, a strong USD will show a downtrend on the Euro USD chart. But if you're trading a pair in which the USD is the base currency, such as the USD CHF, a rise in the USDX will most likely show a rise in USD CHF charts like the one shown below. Next page, please. Next page, please. Yep. So now, if USD is the base currency, for instance, you're seeing a USD CHF, USD JPY, and you understand that the currency pair should move from the same direction. If USD is the core currency, for instance, GBP, USD, Euro, USD, then the USDX index and the currency pair should move in opposite directions. So get it. There are two little tips you should always remember. If the USD is the base currency, for instance, USD JPY, then the USDX and the currency pair should move in the same direction. But if the USD is the core currency, like GBP USD, Euro USD, then the USDX and the currency pair should move in quite opposite directions. Next page, please. Now, the dollar smile theory. been a while. Um, you ever wonder why the dollar strengthens both in lines of, tough luck and when the economy is booming, like, you know, and a former currency strategist and economist comes up with a theory and named it the dollar smile theory. Now, this theory of his depicts three main scenarios directing the behavior of the United States dollar. And here's one simple illustration to this one. The USD strengthens due to risk aversion. USD strengthens due to economic growth. The USD weakens to new low due to weak economy. Now that's a huge panic button if any of this happens. Next page, please. So the first scenario will be that the first part of the SMI shows that the US dollar has been benefiting from risk aversion, which causes investors to flee to safe haven currencies like the dollar and then the yen. Since investors think that the global economic situation is shaky, they are hesitant to pursue risky assets and will rather buy up the less risky US dollar, regardless of the condition of the US economy. Now, dollar drops. Scenario two is this: dollar drops to a new low, and the bottom part of the smile reflects the lackluster performance of the greenback on the US economy grapples with weak fundamentals. Now, the possibility of interest rate cuts also weighs the US dollar down. This leads to the market shying away from the dollar, and the motto for USD becomes to just sell, to just sell, and to just sell. Next page, please. Scenario three, the dollar appreciates due to economic growth, very importantly. Lastly, a smile begins to form as the US economy sees the light at the end of the tunnel. As optimism picks up and signs of economic recovery appears, and sentiment towards the dollar begins to pick up. In other words, the greenback begins to appreciate as the US economy enjoys a stronger GDP growth and expectations of interest rate hike, somewhat increases. And this theory appears to have been in play when the 2007 financial crisis began. Remember that the dollar got a huge boost at the peak of the global recession. That's phase one. And when the market eventually bottomed, out in March 2009, investors suddenly switched back to the higher yielding currencies, making the dollar the winner of the worst currency award for 2009. Right? Next page, please. That's scenario three. Now, very importantly, we will just have a brief look at these scenarios and importantly note out some things. So the smart theory on this is this: will this dollar smart theory hold true? Only time will tell. And in any case, there is an important theory to keep in mind. Remember, all economies are quite cyclical. The key part is determining which part of the cycle the economy is in and the economy is going to be in. Right? Next page, please. How gold affects AUD USD and USD CHF. Now, before we detail the relationship between the dollars and gold, let's first know that the US dollar and gold didn't quite mesh very well. Usually, when the dollar moves up, the gold falls and vice versa. The traditional logic here is that during times of economic unrest, investors tend to dump the greenback in favor of gold. Unlike other assets, gold maintains its intrinsic value, or rather its natural shine. Gold and the AUD USD, for instance, nowadays the inverse a relationship between the greenback and gold still remains, although the dynamics behind it have somewhat changed because the dollar is safe haven appeal whenever there is economic trouble in the US or across the globe. Investors more often than not will run back to the greenback, and the reverse happens when there are big signs of growth. Next page, please. Now you take a look at this wonderful chart. This is gold and AUD USD, so much alike. Currently, Australia is the biggest gold digger, right? We mean because gold producers in the world are selling out about 5 billion worth of the yellow treasure every year, arguably every year. Next page, please. Now, gold has a positive correlation with AUD USD. When gold goes up, the Aussie dollar goes up. When gold goes down, the Aussie dollar goes down as well. Historically, Aussie dollar has been a whooping 80% correlation to the price of gold. Are you not convinced yet? Here's another chart outlook. Now, the blue one represents gold, while the red represent the USD chef. Have a quick look. You spot some similarities? Right. Next page, please. Across the seven seas, the Switzerland currency, the Swiss franc, also has a strong link with gold, using the dollar as its base currency. The USD chef usually climbs when the price of gold slides. Conversely, the pair dips when the price of gold goes up, unlike the Australian dollar. The reason why the Swiss franc moves along with gold is because more than 25% of Switzerland's money is backed by gold reserves. Gold has a negative correlation with the United States chef. And when gold goes up, USD chef goes down. When gold goes down, USD chef goes up. Isn't that quite awesome? The relationship between gold and major currencies is just one of the many that we will tackle. Next page, please. Oil and the USD card. Now, let's talk about the other kind of gold, which is the black one, the oil. As you may know, crude oil is often referred to as black gold, or as we hear it, you call it black crack. One can live without gold, but if you crack an addict, you can't live without crack. Just like an addict, rather, you can't live without crack. So oil is the drug that runs through the veins of the global economy as its major source of energy. Canada, one of the top oil producers in the world, exports around 2 million barrels of oil a day to the United States. And this, of course, makes it the largest supplier of oil to the United States. This means that Canada is United States' main black crack dealer, the main black crack dealer. Next page, please. Now, also take note that Canada's economy is dependent on exports, with about 85% of its exports going to its big brother down south. Now, take a look at the oil and United States USD card chart. The oil is the blue, USD card is the red, of course. Because of this, USD card can be greatly affected by how US consumers react to changes in oil prices. Next page, please. If US demand rises, manufacturers will need to order more oil to keep up with demand. Now, this can lead to a rise in oil prices, which might lead to a fall in USD card. So if US demand falls, manufacturers may decide to chill out since they don't need to make more goods. Demand in oil might fall, which could, hurt demand for the Canadian dollar. And oil has a negative correlation with United States card, USD card. Of course, when oil goes up, USD card goes down. And when oil goes down, USD card goes up. So the next time you gas up on your car and see that oil prices are rising, you can use this information to take you to your advantage. It may be a clue for you to go short on USD card. Some Forex brokers allow you to trade gold, oil, and other commodities. There you can really pull up their charts using their platforms. You can also monitor the prices of gold on Bloomberg. You can likewise check the prices of oil on Bloomberg as well. Next page, please. Importantly, one of our very strong and this topic is very, very vital. How bond yields affect currency movements. A bond is an IOU issued by an entity when it needs to borrow money, in layman definition. These entities, such as governments, municipalities, multinational companies, they need a lot of funds in order to operate. So they don't often need to borrow from banks or individuals like you. When you own a government bond, in effect, the government has borrowed money from you. And you might be wondering, isn't that the same as owning stocks? One major difference is that bonds typically have a defined term to maturity, wherein the owner gets paid the money he loaned. Now, known as the principal at a predetermined set date, also when an investor purchases a bond from a company, he gets paid at a specified rate of return, also known as the bond yield, at certain time intervals. Now, these periodical interest payments are commonly known as coupon payments. Bond yields refers to the rate of return or interest paid to the bondholder, while the bond price is the amount of money the bondholder pays for the bond. Next page, please. Now, bond prices and bond yields are inversely correlated. When bond price rises, bond yields fall and vice versa. Here's a simple illustration. Next page, please. How bond spreads between two countries affect their exchange rate. Spread some bonds all over me. Now, the bond spread represents the difference between two countries' bond yields, and these differences will give rise to carry trades, which we discussed in a previous lesson. So, by monitoring bond spreads and expectation for interest rate changes, you will have an idea of where currencies are headed to. Right? Next page, please. Bond spread versus the AUD USD. As the bond spread between the two economies widens, the currency of the country with a higher bond yield appreciates against the other currency of the country with a lower bond yield. Now, you can observe this phenomenon by looking at the graph of AUD USD price action and the bond spread between Australian and the US 10-year government bonds from January 2000 to January 2012. Next page, please. Now, you notice that when the bond spread rose from 0.5% to 1% from 2002 to 2004, Aussie dollar rose almost 50%, rising from 5.5000 to 0.7000. Now, the same happened in 2007 when the bond differential rose from 1% to 2.5%. The Aussie dollar rose from 0.700 to just above 0.900. That's about 2,000 pips. Now, once the recession of 2008 came along and all the major central banks started to cut their interest rate, Aussie dollar plunged from the 0.9000 hand back down to 0.7000. So what happened here? One factor that is probably in play here is that traders are taking advantage of carry trades. When bond spreads were increasing between the Aussie bonds and the US treasuries, traders loaded up on their long AUD USD positions. Why? Because they needed to take advantage of carry trade. However, once the Reserve Bank of Australia started cutting rates and bond spreads began to lighten, traders reacted by unwinding their long AUD USD positions as they were no longer as profitable as expected. Next page, please. How fixed income securities affect currency movements. Now, a quick recap. So far, we have discussed how differences in rates of return can serve as an indicator of currency price movements. As the bond spread or interest rate differential between two economies increases, the currency with a higher bond yield or interest rate generally appreciates against the other. So much like bonds, fixed income securities are investments that offer a fixed payment at regular time intervals. Economies that offer higher returns on their fixed income securities should, of course, attract more investments. And this would make, their local currency more attractive than those of other economies offering lower returns on their fixed income market. For instance, let's consider gifts and hearables. we're talking about the UK bonds and the European security levels here, of course. Now, if Euroballs are offering a lower rate of return compared to gilts, investors will be discouraged from putting their money in Eurozone's fixed income market and will rather place their money in higher yielding assets. Because of that, the euro would weaken against other currencies, particularly the Great British pounds. Next page, please. This phenomenon applies to virtually any fixed income market, and for any currency, you can compare the yields on the fixed income securities of Brazil to the fixed income market of Russia and use the differentials to predict the behavior of the real and the ruble. Or you can look at the fixed income yields of Irish securities in comparison to those in Korea. You understand the thing, what I'm trying to say. And if you try to hand add these correlations, data on government and corporate bonds can be found on these two websites. You have Bloomberg, we have Trading Economics, we have investing.com. You can also check out government websites of a particular country to find out the current bond yields. Those are very accurate, of course. They are the government, you can trust them. So in fact, most countries offer bonds, but you might want to stick to those whose currencies are part of the majors, right? Next page, please. Now, here are some of the popular bonds from around the globe and their cool nicknames. You might come across them in Forex website, blogs, Forex sites in general. You have the United States, US Treasury bond, Yankee bonds. We have the United Kingdom called the gilts or the bulldog bonds. We have Japan called the Japanese bonds or the samurai bonds, Chiki. We have the Eurozone bonds called the Eurozone bonds, of course, or the Euroballs and Euriball, sorry. And we have the German bonds called the bonds with the UNDS. We have the Switzerland called the Swiss bonds. We have Canada called the Canadian bonds. We have Australia called the Australian bonds, kangaroo bonds, Matilda bonds. And the New Zealand bonds, of course, called the New Zealand bonds and the Kiwi bonds, while the Spanish bonds called the Matador bonds. Some countries also offer bonds with varying terms to maturity, so just make sure you are comparing bonds with the same term to maturity, such as a 5-year gilts to 5-year Euroballs, and otherwise your analysis, most likely might be off. Next page, please. Forex and global equity markets. Did you know that equity markets can also be used to help gauge currency movements? In a way, you can use the equity indices as some kind of a Forex crystal ball, because based on what you see on the television, what you hear on the radio, and what you read in the newspaper, it seems like, that the stock equity market is the most closely covered financial market. It's definitely exciting to trade since you can buy the companies that make the products you can't live without. Right? Next page, please. To invest in stocks in Japan, a European investor must first exchange his euros into Japanese yen. One thing to remember is that in order to purchase stocks from a particular country, you must first have the local currency. The increased demand for JPY causes the value of JPY to appreciate. On the other hand, selling euros increases its supply, which drives the euro's value a bit lower. But when the outlook for a certain stock market is looking good, international money flows in. On the other hand, when the stock market is struggling, international investors take their money out and look for a better place to pack their funds. Even though you may not, trade stocks as a forex trader, you should still pay attention to the stock markets in major countries. Now, if the stock market in one country starts performing better than the stock market in another country, you should be aware that money will probably be moving from the current country with a weaker stock market to the country with a stronger stock market. Just as simple as that. And this could, of course, lead to a rise in value of the currency for the country with a stronger stock market. Now, why the value of the currency could depreciate for the country with a weaker stock market? The general idea is this: strong stock market, strong currency, weak stock market, weak currency. And if you bought the currency from the country with a stronger stock market and sold the currency from the country with a weaker stock market, you can potentially make some good money. Next page, please. Yeah, right now we'll be looking at just to familiarize yourself with market major global equity indices. We have the Dow, we have S&P 50, and we have Hang Seng. So we'll be taking them one after the other shortly. Now the Dow Jones Industrial Average, Dow for short, is considered to be one of the premier stock indexes in the US. It measures how well the top 30 public-owned companies are trading. Despite the name, barely any of the companies have anything to do with industrial production and are instead representatives of some of the biggest companies in America. Now, it is closely watched by investors around the world and is highly indicative of market sentiment, thus making it sensitive to both local and foreign and economic and political events. The companies that are part of the Dow are so large that you probably deal with at least one of them every day. Imagine life without AT&T, McDonald's, Visa, or Intel. These companies are listed in Dow, and the Standard and Poor 500, more commonly known as the S&P 500, is a weighted index of the stock prices of the 500 largest American companies. It is considered a bellwether for the American economy and is used to predict its direction after the Dow Jones Industrial Average. It is the most traded index in the US. Now, next, the S&P 50. Some mutual funds, the next NASDAQ, which stands for National Association of Securities Dealers Automated Quotations. It refers to the largest electronic screen-based equity securities trading market in the US, comprising of approximately 3,700 companies and corporations, of course. It also boasts of having the largest trading volume among the world stock markets. Now, the Nikkei, similar to the Dow Jones Industrial Average, is the most widely quoted average of the Japanese stock market. It is price weighted. It is a price weighted average of the top 2 to 5 companies rather, and is supposed to be reflective of the overall market. The Nikkei includes companies like Toyota, Japan Airlines, and Fujifilm. Now we talk about DAX. The DAX is short for the Deutsche Aktien Index. You're probably better off remembering just as DAX. It is a stock market index in Germany that consists of the top 30 blue chip companies that are traded on the Frankfurt Stock Exchange market. With Germany being the largest economy in the Eurozone, the DAX is normally the most closely watched index within the whole Eurozone. Some companies that are part of the DAX are Adidas, BMW, the Dutch Bank, of course. Now we have the DJ Euro Stock Index. Stock 50 Index is the Euro's leading chip index. It comprises over 50 sector top stocks from 12 Eurozone countries, and it was created by Stocks Limited, which is a joint venture of Dutch Beurs AG, Dow Jones and Company, and SIX Swiss Exchange. Then we also have the FTSE, which is pronounced as the FTSE index, which tracks the performance of most highly capitalized UK companies listed on the London Stock Exchange. There are several versions of this index, such as the FTSE 100 or FTSE 250, depending on the number of companies included in this index. Now, the Hang Seng Index is a stock market index in Hong Kong, by recording and monitoring the daily price changes of the stocks included in the index. It tracks the overall performance of the Hong Kong stock market. The index is currently compiled by the HSI Services Limited, which is a subsidiary of Hang Seng Bank. Next page, please. Here's a close relationship between the stocks and Forex. Now, one issue with using global equity markets to make Forex trading decisions is that you end up figuring out which leads which. It's like answering the age-old question, which came first, the chicken or the egg? Who's, you know, on the flip side, when a domestic equity market performs terribly, confidence falters, causing investors to convert their invested funds back into their own local currencies. Last couple of years, however, the principle holds contrary for the US and Japan, and any upbeat economic figures in the US and Japan, more often than not, weigh down on their respective currencies, the dollar and the yen. Next page, please. Next page, please. First, let's take a look at the correlation between the Dow Jones Industrial Average and the Nikkei to see how stock markets all over the globe perform relative to each other. Since the turn of the century, the Dow Jones Industrial Average and the Nikkei 225, the Japanese stock index, have been moving together like lovers on Valentine's Day, falling and rising at the same time. Also notice that sometimes one index leads, rallying or dropping first before being followed by the other index. So you could say that stock markets in the world generally move in the same direction. Major of them, major of them. Next page, please. How the stock market affects the Forex market. Now let's have an example with Nikkei and the USD JPY. Before the global economic recession that started in 2007, when most economies suffered consecutive quarters of negative GDP growth, the Nikkei and the USD JPY were inversely correlated. Investors believed that the performance of the Japanese stock market reflected the status of the country. So a rally in the Nikkei led to a strengthening of the yen, and the opposite also held true. So whenever the Nikkei would drop, USD JPY, of course, would rise as predicted. Next page, please. So when the financial crisis hit, however, the relationship just went crazy, like a top musician, Lindsay Lohan, actress. So the Nikkei and USD JPY which used to move oppositely, now move in the same direction. Now have a look at the chart of the Nikkei and the USD JPY between the year 2000 to 2011. Can both see that both had a positive correlation, right? Yeah. Next page, please. Correlation between USD JPY and Dow Jones. Take a look at the correlation between USD JPY and Dow. Based on what you've read earlier, you might assume that the USD JPY and Dow will be highly correlated. However, a look at the chart below will tell you that it isn't quite the case. While the correlation is positive, it isn't as strong as expected. Take a look at this. Between the year 2000 and 2024. Take a look at the blue line, which is for Dow. Got it. Next page, please. How to use Euro JPY as a leading indicator for most stock markets. As we said earlier, in order to for everyone to invest in a particular stock market, we should need the local currency in order to purchase some stocks. You can imagine what the effect of stock markets like the DAX, the German stock market, have on currencies. In theory, whenever the DAX rises, we can probably expect the euro to rise as well. As investors need to get a hand on some euros, while the correlation is imperfect, statistics show that it still holds pretty accurately. While you should know that the yen, along with the US dollar, are considered to be safe haven amongst the major currencies. And whenever confidence in the global economy is down and traders are fearful, we typically see traders take their money out of the stock markets, which leads to a drop in the values of the DAX and S&P 500. So with money flowing out of these markets, we usually see Euro JPY fall as traders run for cover. Next page, please. So on the flip side, when the sun is bright and risk appetite is rampant, investors pour their money into stock market, which in turn leads to a rise in the Euro JPY. So you take a look at charts below to see the correlation between the Euro JPY and DAX and S&P 500. So take a look at this. Next page, please. So the same correlation continued between 2000 and 2011, and the correlation seems to have held well throughout the past decade as Euro JPY and both indexes rose steadily together until 2008, when we were hit with a financial crisis in late 2007. Euro JPY had hit its peak, and so did the stock indexes. So this should make sense to everyone now. Next page, please. Intermarket analysis cheat sheet. Yeah. So it will be consisting of if and thens and the reason why. Now, there are a lot of intermarket correlations to remember, so let's do a quick recap. The price action of currencies is often driven by their relationship with commodities, bonds, and stock indices. Now, here's a neat one-page cheat sheet for you to understand this quickly. You see gold, Aussie dollar. If gold was up, then the Aussie dollar will be down. Now, during times of economic unrest, investors tend to dump the dollar in favor of gold. Unlike other assets, gold maintains its intrinsic value. Now, in the case of gold with Aussie dollar and the New Zealand dollar, if gold is up, the New Zealand dollar will be up. And the reason why is the third biggest gold producer in the world, selling out about 5 billion dollars a year. And New Zealand is also a large producer of gold. Next page, please. "25% of Switzerland reserves are backed by gold. As gold prices goes up, the pair moves down, CHF is bought. Canada is the fifth largest producer of gold in the world. As gold price goes up, the pair tends to move down. Canadian dollar is bought. Canada is one of the top oil producers in the world. It exports around 2 million barrels oil a day to the US. As oil price goes up, the pair goes down. Just as simple as that. Next page, please. Since both gold, we have bond yields and local currency. Since both gold and euros are considered anti-dollars, the price of gold goes up. For instance, you have Euro USD may go up as well, and an economy that has offer higher returns on its bonds attract more investment, and this makes its local currency more attractive than that of any other economy offering lower returns on its bonds. Now, the performance of the US economy is closely tied with Japan, and investors consider the yen as a safe haven and tend to seek it during periods of economic distress. Next page, please. I think that should be all. Yep, so that brings us to the end of today's session on the Holiday Trader 2. I wish you all a very, very, very happy Xmas. Enjoy yourself, trade safely, trade smartly, and we'll be back again, hopefully next week or upper week. Thank you.